Hello, and welcome back to Reflections on Investing with the Cornell Capital Group. And today we're going to talk about growth options, something we've addressed in the past, but with the market down and volatility up, understanding the role of growth options becomes particularly critical. So, to make the issue practical, let me use an example. And Tesla is perhaps the best example. You can think of Tesla's business as being composed of two parts. The first part is the business they're actually doing now, and that is almost exclusively selling cars and light trucks and selling energy products such as batteries and solar panels. But the company also says it's going to do other things in the future, other things that may be even much more profitable. And if that's true, the value of the stock today can reflect those future opportunities. And what are those opportunities? Well, no better source to go to than Mr. Musk, who at the last shareholders meeting said the following. And I think we could make one Tesla robot for a cost of maybe at really high scale of about $10,000. It'd be less expensive than a car. And I think if you sell it for $20,000, I think this is a large scale volume, Tesla would basically make $1 trillion of profit a year from that. If the price earnings multiple is, say, under 20 or 25, something like that, that would mean $20 trillion market cap from Optimus alone, and probably 5 to 10 from autonomous vehicles, something they also don't sell at this time. So I think it's actually conceivable, it's within the realm of possibility, for Tesla to achieve a valuation 10 times that of the most valuable company today. In other words, over $30 trillion market cap. And those are all growth options. Now, if there's even a remote possibility that that's going to come to pass in the next decade, and even if you discount back to the present, $30 trillion makes Tesla far more valuable than Apple, as opposed to its current valuation of less than $1 trillion. So, how do these growth options actually affect the stock price? Let's look at Tesla's stock price. And you can see it bouncing around between like 200 and 250 until about the time of the shareholders meeting. And it suddenly takes off and rockets up to $488 a share maximum. This is the impact of the growth options. Nothing really changed in their ongoing business, of the revaluation of the growth options, because both of what Mr. Musk said and his relationship with Mr. Trump. But growth options are tenuous. Their valuation can jump and then collapse on little information about the current business. And in recent months, Tesla has dropped back from $488 to under $250 a share, primarily because investors are becoming concerned that the growth options that Mr. Musk spoke of won't be realized, either because he's distracted with the political world, or because consumers have become upset about his activities and are shying away from Tesla products. So this shows you the incredible sensitivity of stock prices to growth options. And to take this one step further, here is the 12-month forward PE ratio of Tesla versus Ford. Now, why am I looking at the 12-month forward PE ratio? The amount that someone is willing to pay for $1 of future earnings is intimately connected to the growth options that that company has. And if you look at Ford here, that's the blue line down there, the forward PE ratio is less than 10 the entire time. But Tesla's jumps between 40 and over 140. And all these big movements in Tesla's stock price are not because the current business has changed that much, though it does change. They're because the growth options get revalued. And you might ask, well, what is Tesla worth without the growth options? Well, to answer that question, I would refer you to a recent valuation posted by my colleague Aswath Damodaran on his website, Musings on Markets. And at that, his valuation comes out to be about $148 a share, significantly less than the current stock price. But that is not his valuation of the current businesses, because he includes self-driving software and robotaxis in his valuation. I went back and stripped those out, so we're looking at just the actual businesses that exist today, and it comes out to be less than $100 per share. So you can think of Tesla as having two parts: the current business, including the growth in the car sales, but the car sale and energy business, and everything else. And the car sale and energy business are worth somewhat less than $100 a share, and the difference between that and the stock price reflects the growth options. Now, one final thing about growth options. Because they are things that don't exist yet, they are projections of the future, they tend to be very sensitive to market sentiment. When investors are confident, when they're requiring smaller risk premiums, these distant, hoped-for growth options have greater value. When they become more risk-averse, when the rate at which they discount future opportunities grows, the value of those future growth options declines substantially. And I think in today's market conditions, we're going to see a lot of variation in the value of growth options. So at the Cornell Capital Group, we're watching this carefully. And it's not just fancy companies like Tesla. To conclude here, I've also plotted Apple's PE ratio for the last 2 years. And you can see that even Apple, which you think of as a staid company, the PE ratio has changed from 26 to over 38. That is almost exclusively due to the market revaluing Apple's future growth options. So, bottom line, if you have money at risk in today's market, think carefully about how much of that value is coming from growth options and how the value of those growth options is likely to change over time. This has been Reflections on Investing with the Cornell Capital Group. Thanks for joining us.